Hello everyone, I'm CA, CFA, CPA Praveen Khatod. In this video, we are going to talk about Sharpe's optimization framework, or we can also call it as Sharpe's optimum portfolio. Now, what do we mean by optimization? Optimization means designing a portfolio that has maximum returns with least possible risk. Let us get into a situation. You are analyzing some stocks and you have a list of 10 stocks in front of you. And now you are pondering that in which of these stocks shall I invest my money and how much shall I invest in each of the stock. So let us suppose you have 10 stocks. Somehow you are able to figure out that I shall invest my money in this 4 stocks. And now the next question to answer is how much shall I invest in each of these 4 stocks. So you want to know the weights that you should give to your stocks in the portfolio. So all these questions are answered in today's lecture by teaching you Sharpe's optimization framework. Okay, so what all data do you need to apply this process? So this is an iterative process. It's a pure mechanical process. This process has been derived by performing matrices and matrix differentiation. So instead of going into the derivation part, we are going into the procedural parts in this video. So what are the required inputs? There are two types of inputs which are required. One are stock specific inputs and another are market related inputs. So if you have a list of 10 stocks, then you need this 3 information about this 10 stocks. One is you need to have expected return, which means you have thoroughly researched the stocks and you have a target price in front of you that this stock is currently trading at suppose 100 and it might go up to 120 in next 1 year. So expected return is 20%. Another information that you need is beta of this 10 stocks. So here beta means it is a measure of systematic risk. And we have covered in a separate video how to calculate beta of stocks. Then there is one more information that is unsystematic variance. So beta is a measure of systematic risk. Here we need one more information, unsystematic variance, or we can also call it as company specific risk. So remember one thing, that here we don't need unsystematic risk. We actually need unsystematic variance. Okay. Now another set of information that we need are market related information, risk-free rate of return, and another is market variance. Now pay attention over here. This is not market standard deviation. This is actually market variance. So it is a square of market standard deviation. If we have this 5 information, then we can design an optimal portfolio that gives us maximum possible return with minimum possible risk. Now there are certain steps that we have to perform. Now before I teach you the steps, let me show you some information. Okay, so here I am flashing a question in front of you, so we have a nice background that on this particular set of information we are going to apply our process. Okay. Question is, Ramesh wants to invest in stock market. He has got the following information about individual securities. So he has prepared a list of 6 securities. We have expected return of each of the 6 securities. We have beta of 6 securities and we have deviation square EI, where I means an individual security. Deviation square means variance. And here we have written E, where E denotes error term, or we can call it as unsystematic. So it is here E denotes unsystematic. The square denotes that it is variance. So it is unsystematic variance of an individual security I. So security A has unsystematic variance of 40%, security B has unsystematic variance of 20%, and so on. Market index variance is 10% and risk-free rate of return is 7%. So I think in this question we have got all the 5 sets of information. We have got stock specific expected return, beta, and unsystematic variance. We have got market related information, risk-free rate of return, as well as market variance. The risk-free rate of return is 7% and market variance is 10%. So please pay attention over here. This is not market standard deviation. This is actually market variance. What should be the optimum portfolio assuming no short sales? Now in this video I am covering the concept of designing an optimum portfolio with no short sales. There is one more concept for which I am going to prepare another video, how to construct an optimal portfolio when there is a concept of short sales as well. So when there is no concept of short sales, then all these stocks are going to have positive weights because you can only buy the stocks, you cannot sell them. But if short sales are allowed, then you can have negative weights in the overall portfolio for some of the stocks that you are shorting. Okay, for right now we are learning how to create an optimum portfolio assuming no short sales using Sharpe's optimization framework. Okay, so it is a simple three-step process. The steps are simple. The formula might be a little bit tricky, but okay, we are going to understand each and everything in a very proper manner. So step number 1, calculate excess return to beta ratio. This is also called as trainer's ratio, and you have to rank the portfolio. Okay, now these are three very logical steps. See, let us do one thing. We have been given the 6 securities. Okay, and now security A is earning me 15% return. The security E is earning me only 8% return. If I ask you to compare security A versus security E, which security are you going to prefer? You would obviously say, sir, this security A should be preferred. Why? Because it has got higher returns. Okay. Now you should pay attention to one more data, and that is systematic risk. Here the systematic risk is 1.5 times, whereas in case of E, the systematic risk is 1.2 times. So although security E has lower returns, it also carries lesser risk in terms of lesser beta. Okay, so what we shall do is we shall compare the securities based on both their expected return as well as their beta. Now there is one more catch. When you are considering risk, then you should also consider the returns which you are going to earn by taking that risk. See, we have risk-free rate of return of 7%, which means you can easily earn 7% without taking any kind of risk. Now, in case of stock A, your expected return is 15%. Now, this 15% total return is not coming by taking the risk. You can easily earn 7% return by not taking the risk. So if you are earning 15% in some stock, then only excess return of 8% is being earned by taking the risk. So what we should do is we should compare this 15% return. We should deduct the 7%, that is the risk-free rate of return, and the excess return is 8%. The excess return is 8%. Okay. In case of security E, the excess return is just 1%. Now I can simply compare. I am earning 8% by taking 1.5 times risk. I am earning 1% return by taking 1.2 times risk. Now how do I compare these two stocks? Simply divide the excess return by beta. Simply divide the excess return by beta. So what it is going to give you? It is going to give you excess return per 1 unit of beta, which means excess return per 1 unit of risk. And now you can prepare a list in a descending order where you would write the first stock being the stock that gives you highest excess return per unit of beta. The second in the order would be next highest excess return per 1 unit of beta, and so on. You will have a list being prepared in the descending order of your preference. Okay, so the step number 1 is to calculate excess return to beta ratio, where what do we mean by excess return? Excess return means return on an individual security. Let me write the formula. The formula is return on an individual security minus risk-free rate of return. It is excess return. Divide it by beta of that individual security. So this is how we calculate excess return to beta ratio. And now you are going to rank the portfolios. The solution might look like, let me flash the solution in front of you. These are the 6 securities. These are the returns of those securities. We have calculated the excess return. This is excess return, and let us divide this excess return by beta. So you get excess return to beta ratio. It may also be called as trainer's ratio. Now here we can see that which security has highest excess return to beta ratio. Security A has highest excess return to beta ratio. So we can rank it as first. We can rank the security as second rank, and then third rank goes to security B. Fourth rank goes to D. fifth goes to C, and then sixth rank goes to E. Okay, so we can rank the securities. Now I can prepare a ranked table where first rank went to security A with excess return of 8 and beta of 1.5. Second rank went to F with excess return of 7% and beta of 1.5, and so on. So I have written the securities in the order of their rank. See, I have to prepare a portfolio. I'm not going to invest all my money in security A by just saying, see, this security has the highest excess return to beta ratio, so let us invest 100% of the money in this security. No, there is no logic, there is no rationale in putting all your money into one security. You might have heard a common quotation, don't put all your eggs in one basket. The same analogy goes here. We are not going to invest 100% of the money in security A. Rather, we are going to diversify the investment. So we have to select more than one security in which we can put our money. But now we have two questions in front of us. First question is, these are 6 securities. Now, which securities shall I select? Which securities should form part of my portfolio? It might be A, F only. It might be A, some investments in A, some investments in F, and some investments in B. And it could be, I am going to invest in A plus F plus B plus D. And it could be A, F, B, D, and C. So now I have to decide that which securities shall I select. So it is just like a competitive examination where lakhs of the students, they give the exam and the authority decides a cutoff. See, above this cutoff, whoever has scored above this cutoff level, they all will be selected, and whose score fell below the cutoff, they will be rejected. So now, to identify which securities shall we select, we have to find out the cutoff. And now this is our next step. We prepare the ranked table in the order of rankings, and we calculate CI, where CI means calculation of C for an individual security, and we determine the cutoff. And how do we denote cutoff? By C star. Okay, so now all the securities that have excess returns to beta ratio above cutoff will be selected, and those securities with excess return to beta ratio below cutoff, they will be rejected. Okay, so now how do we calculate cutoff and how do we calculate CI? Okay, so that's a very tricky formula. Let us not go into that formula for right now, but yes, I'm sure now you have known the procedure, that by doing something we will be able to figure out which of the securities should be selected. The next question is, suppose we have selected these 3 securities for investments. Now the question is, how much percentage money out of the total 100% money? Suppose I have $1 lakh to invest, right? So how much, what percentage of my portfolio should be invested in A, what percentage of my portfolio should be invested in F, and what percentage of my portfolio should be invested in B? So this is the second question that we are going to answer in our step number 3, is to calculate the weights, right? So in step number 2, we essentially select in which securities to invest. In step number 3, we find out the weights to be put in those selected securities. Now there are some tricky formulas. Now let me write the formula for step number 2. The formula for step number 2 is CI is equal to deviation m square divided by 1 plus deviation m square. So this is the formula. Deviation m square divided by 1 plus deviation m square. Hey, you were saying the formula was very tricky, and that's a very easy formula. Deviation m square divided by 1 plus deviation m square. Okay, wait. Now we have to multiply it and again multiply it by something and something. Now this something is not the same thing. It is something 1 and it is something 2. Okay, so let me tell you what is that something, and let me write the complete formula so you will automatically know what is that something. CI is equal to deviation m square multiplied by summation of I is equal to 1 to n. And then we have to write Ri minus Rf. divided by, okay, divided by deviation EI square into beta. Okay, so that's the formula for something 1 divided by 1 plus deviation m square into summation of I is equal to 1 to n multiplied by beta of an individual security square divided by variance of an individual security square. Okay, so that's the formula to calculate CI. Okay, now this formula might look very tough at the first glance, but let me give you an assurance. Once we apply the process, this formula will be very easy for you. Okay, so this is how we calculate CI for each of the individual securities, and based on various CIs we are able to determine the cutoff. Okay, and now later we have to calculate the weights. Now what is the formula to calculate the weights? The formula to calculate the weights, so there are two formulas over here. The first formula is ZI. ZI is equal to beta divided by deviation EI square multiplied by return of an individual securities minus RF divided by beta minus C star. Okay, so that's the formula to calculate ZI, and based on ZI we can calculate the weights. Okay, now this process can be easily understood only and only with the help of an example. So let me flash that example in front of you, and we are going to solve this example right from the scratch. Okay, so that's an example in front of us. Okay, and we have to determine the optimum portfolio assuming no short sales. So please tell me, how shall I proceed? You know the 3 steps. Which one was step number 1? Step number 1 is to find out excess return to beta ratio. Okay, so let us solve it in our copy. Okay, step number 1. Step number 1 is to calculate excess return to beta ratio, and we can also call it as trainer's ratio. Okay, let me clarify some things. This question is available in a PDF form in the link given in the description box, so you can simply click on that link and download this question along with the solution. So both question as well as solution are available. Second thing, although I am solving the question over here, but I would highly recommend that you also pick up copy pen and start solving along with me. So I'm going to flash the question in front of you. We both are solving, and once you solve with the complete process, you will be clear with the 100% of the process. Okay, so step number 1 is to calculate excess return to beta ratio. I hope you have already picked up copy, pen, paper, and we both are solving together. Then only you are going to get some clarity on this particular process. Okay, so we have to calculate excess return to beta ratio, and for that we have to prepare some columns, where first column will be security. Which securities are we talking about? Then expected return on such securities, and then risk-free rate of return, and then beta, and then we are going to calculate RI, where RI means expected return. RI minus RF upon beta. It simply means excess return to beta ratio. Okay. Okay, so we are going to prepare this table, and let me pull the data. So we have securities A to F. Security A, security B, C, D, E, and security F. Let me write the excess return: 15, 12, 10, 9, 8, 14. 15, 12, 10, 9, 8, and 14. Okay, the risk-free rate of return given in the question is 7%. So it is 7% all over. And let's write beta. So it comes to 1.5 to 2.5, 1.5 to 2.5, 1, 1.2, and 1.5. Okay, so let's pick the calculator and we have to calculate excess return. So how do we calculate excess return? 15 minus 7. So we have an excess return of 8%. We are earning 8% by taking 1.5 times risk. Let us divide it by 1.5. So we are earning 5.33% per 1 unit of beta per 1 unit of risk. We are earning excess return of 5.33%. Now 12 minus 7 divided by 2, it gives you 2.5. Okay, then 10 minus 7 divided by 2.5. So 10 minus 7 divided by 2.5, it gives you 1.2. Then 9 minus 7 is 2, divided by 1 is 1. Then it comes to 1 divided by 1.2, which means 0.83. And then 14 minus 7 divided by 1.5, it comes to 4.67. Okay, now let's prepare one more column called as rankings. So let's rank the securities where first rank will be given to the security which is giving us highest excess return per 1 unit of risk. So first rank goes to security A, then second rank goes to security B, security F, third rank goes to security B, fourth rank, fifth rank, and then sixth rank. Okay, and now we have to prepare a table in the order of rankings so that we can apply our step number 2. Okay, step number 2. Step number 2 is prepare ranked table and determine CI. Okay. Now, here is the tricky part. So, first column will be security. First column will be security. Okay. So, we are going to write A, B, C, D, E, and F. A, B. No. Please don't make this mistake of writing A, B, C, D, E, F. We have to prepare a ranked table and we have to write in the order of rank. So, first thing that we are going to write is security A. Okay, so we have to write security A. Then second rank went to with security F. So here we have to write F. And then third is B, fourth is D, fifth is C, and then sixth is E. So we have to prepare a table in the ranked order. Okay. Now here comes the very tricky formula that we have to apply. Now to apply this formula, we are going to break it down into some parts. See, this is deviation m square and that is fine. Deviation m square is already given. Deviation of market, yani variance of market is already given at 10%. Okay, so this is going to be pretty easy. We are not going to make this number part of the table right now. So let's ignore this. Let's ignore this part. We have to mainly focus on getting these two numbers. Okay. So first of all, what we are going to do is we are going to calculate Ri minus Rf upon beta. We are going to calculate Ri minus Rf upon beta. And do we need to calculate this or we already have this? We already have this here. Ri minus Rf upon beta. So we are going to directly, copy these numbers from here to here. Ri minus Rf upon beta. Okay. Next, what we are going to do is we are going to calculate beta of an individual security square divided by variance, unsystematic variance. Okay, do we have these numbers? Yes, we have these numbers. Look at this question. We already have beta. Okay, so we are going to square these numbers and we already have unsystematic variance. So we are going to simply divide beta square divided by variance. So 1.5 square divided by 40. It will be 2 square divided by 20 and so on. So in this particular table, the first column that we are going to prepare is excess return to beta ratio. This is the first column that we are going to prepare. Okay, then the next column that we are going to prepare is beta square upon deviation EI square, which means unsystematic variance. Okay, let me number these columns so that I can easily refer them. Let it be called as column number 1, This is our column number 2. This is our column number 3. Okay. Now focus on this formula. We want to calculate Ri minus Rf upon variance into beta. But what do we already have? We have Ri minus Rf upon beta, as well as we have beta square upon deviation Ei square. Okay. We have this in column number 2 and we have this in column number 3. We can simply multiply these two columns, column number 2 data multiply by column number 3 data. So one of the beta will get cancelled by this power, and ultimately we will have Ri minus Rf into beta divided by division Ei square, which means we are going to have this portion of the formula. Okay. Now, as far as this portion is concerned, we have already prepared column number 3, which is giving us beta square divided by division Ei square. Okay. So this is what I said earlier, that this formula looks very ugly, but it is relatively easy to execute this formula. Okay, so we have prepared these two columns, Ri minus Rf upon beta and beta square upon division Ei square. Okay, so as per the plan, let's do one thing. Let's multiply column number 2 by column number 3. So column number, let it call as column number 4, where column number 4 is equal to column number 2 multiply by column number 3. Okay, so it is going to give us Ri minus Rf into beta upon unsystematic variance. Okay. Then we already have this column beta square upon division Ei square. Now after this column we are going to need 1, 2 and 3. We are going to need 3 more columns. So make sure that you have sufficient space to make this 3 columns. Okay. Let me write the data. Okay, Ri minus Rf upon beta, Ri minus Rf upon beta. So it is 5.33. It is 5.33. Okay. And then Ri minus Rf upon beta. So it is 2.5. Let's write 2.5. No, please don't make this mistake. This table has securities not in the alphabetical order. Now, in the second row, we have security F. So we have to write Ri minus Rf upon beta for security F. So this is 4.67. This is 4.67. Okay. So beta, security B has Ri minus Rf upon beta of how much? 2.5. So let's write 2.5 here, and then come to security D, it is 2. Let's come to security C, it is 1.2. And then security E, it is 0.83. So please remember that you don't make this mistake while solving. Here everything is in a different order. So make sure that you are picking the correct corresponding number. Okay. Now we have to prepare one more column. Beta square upon variance. Okay. So we already have the betas. Okay. And now we have to first square this betas and divide them by variance. Let's do one thing. Let's move directly to the question. Okay. In case of security A, the beta is 1.5 and variance is 40. So 1.5 square divided by 40. So it gives me 0.05625. So here we go 0.05625. 0.05625. This is beta square upon variance. So what I did is 1.5. I wrote 1.5 on the screen, multiply, multiply and then equal. It gives me 2.25 divided by 40. So beta square upon unsystematic variance comes to 0.05625, and I have written it over here. Now please make sure that you first read the name of the security. It is security F, and then you check the data and pick the data from security F row. So let's write 1.5 multiply equal and then divided by 30. So it is 0.075. We don't need to square this numbers. These are already squared. So the answer is 0.075. Let's write it over here. Okay. Now in case of security B, make sure that you first read the name of the security. Okay, security B. So 2 multiply equal, it gives us 4. Square of 2 is 4 divided by 20. So it comes to 0.20. Okay. Then let's read the name of the security D. Okay, in case of security D, 1 square is 1 divided by 10, so it comes to 0.10. Now let's read the name of the security. It is C. So in case of C, 2.5 is the beta. Let's square it up and divide it by 30. So it comes to 0.2083. So it is 0.2083. Okay. In case of security E, the beta is 1.2. Let us square this number, divided by 20. So it gives you 0.072. 0.072. Okay, now as per the plan, let's multiply column number 2 and column number 3 data so that we get this number Ri minus Rf into beta divided by division Ei square. Okay, so 5.33 multiplied by 0.05625 is equal to 0.2998. Then 4.67 multiplied by 0.075. So it comes to 0.35025. Then 2.5 multiplied by 0.2. So it comes to 2.5 multiplied by 0.2. So it comes to 0.50. Then 2 multiplied by 0.1 is 0.20. 1.2 multiplied by 0.2083, 0.24996. We can also write it as 0.25. Then 0.83 multiplied by 0.072. It comes to 0.05976. Okay. So now let's focus on this formula. What is this formula? Is it Ri minus Rf upon variance into beta, or it is summation of these numbers? From I starting from first security till nth security, which means now in this table we have to prepare two more columns, where first column is going to be summation of these numbers and the next column is going to be summation of these numbers, because in this formula we have summation of these numbers as well. Okay, so let me write it first and then we'll see to it. So summation of Ri minus Rf upon unsystematic variance multiplied by beta, and we are going to start it from I security first and we are going to continue it till nth security. Okay, so it is simply summation of column number 4. So this step is essentially summation of column number 4. Okay, so you already know how to calculate the summation. The first number is going to be the same, but yes, the next number will be added to this number and will arrive at some number. This number will be added with 0.50 and will have some number over here. So this process is going to continue. Let's pick up the calculator. 0.2998. So 0.2998 is written over here. Now let's add this number so that we are able to calculate the summation. 0.35025 is added and it gives me 0.65005. Okay, let's add 0.50, this number. So you get 1.15005. Now let's add 0.2. So it comes to 1.35005. Now let's add 0.24996. So it comes to 1.6001 plus 0.05976. It comes to 1.65977. Okay, so we have essentially calculated the summation of this particular column and we have essentially performed this portion of the formula. Now we have to calculate beta square n divided by unsystematic variance. So we already have beta square by unsystematic variance. We just have to calculate the summation. So let's prepare one more column. Summation of beta of individual security square divided by deviation EI, which means unsystematic risk converted into variance terms, and it will again be done from I to n. So this column is essentially summation of column number 3. Okay, so this is column number 3. Let's sum up the numbers. Okay, 0.05625. Okay, so it will be written same as 0.05625. No worries, 0.05625. Okay, please make sure that you have space to prepare one more column over here. So 0.05625. If by chance you don't have space, I'll tell you the trick how to do it, how to go about it. 0.075 plus 0.075. Okay, so it comes to 0.13125. Now let's add 0.20 plus 0.20. So 0.33125. Now let's add 0.10. So it comes to 0.43125. Now let's add 0.2083. It comes to 0.63955. And now let's add 0.072. So it comes to 0.71155. Okay, so we have calculated summations. So we have essentially performed this portion of the formula. And now the last column that we have to prepare is we have to calculate CI. Okay, so now how are we going to manage in such a short space CI? Okay, so what we can simply do is we can simply write CI over here. We can simply write CI over here, and we can put a line over here, and the calculation of CI is done below. So see below, right? And this is what we have to, do, because it's a wide table. It is not going to fit in one vertical page. So we have to calculate CI here. Calculation of CI. So let us first write the formula to calculate CI. Okay, I hope you remember the formula. Let us recall the formula along with me. CI is equal to, let us first write the simple version of the formula. It is variance of market divided by 1 plus variance of market. Please, I'm going to tell you one thing. Everywhere we are going to use variance. There is nowhere in this process where we use risk. You can see here, we have unsystematic variance, we have unsystematic variance, we have variance of market, we have variance of market, right? So everywhere we are going to use standard deviation in squared terms, which means in variance terms. Okay, so now we have to multiply it by something, and we have to multiply it by something. Now I would suggest that let us first write the denominator, because it is easy to remember the denominator. Do you remember the denominator? We have to multiply it by summation of beta of individual security square divided by unsystematic variance n. I is equal to 1 to n. Okay. Similarly, here we have to multiply it by summation of I is equal to 1 to n. Now let's be very smart over here. Return on an individual security divided by risk-free. Okay. And now we multiply it by beta, but divide it by unsystematic variance. So that's the whole formula. Okay. Yes, that's the formula. Okay, so, or instead of putting in inverted commas here, we could simply put inverted comma here. The meaning would ultimately be the same. Okay, we have already calculated everything. We just have to convert all these calculations. We have to just incorporate all these calculations in this formula. Let me write the simple version of this formula. The simple version of this formula would be deviation m square multiplied by column number. So in which column we have calculated this? In which column we have calculated this? In this column we have calculated this. So multiplied by summation of column 4. So it is multiplied by summation of column 4. Okay. Divided by 1 plus deviation m square and multiplied by summation of. So we have actually summed this up over here, summation of column 3. So multiplied by summation of column 3. Okay, we can alternative do one thing. We could have denoted this as column number 5, and we could have denoted it as column number 6, and it is okay. It is just for your reference. So let us start the calculation of CI. Let me tell you, we have to calculate CA. which means we have to calculate CI for the first security, where first security is CA. So we have to calculate CI, which means we have to calculate C for first security A. So it will be denoted by CA. Okay. And now CA is equal to deviation M square, and deviation M square is 10. Okay. Let me clarify one thing to you. See, here deviation M square V means variance of market, and it is 10%. Okay. So please make sure that you don't make the mistake of writing 0.10 here. No, here we have to write the variance in its full form. Do not make the mistake of writing it in a decimal form. So let me clarify it to you over here. Write deviation M square in full numbers. Don't write in decimal form. So don't write it in decimal format. Okay. So we have written 10 over here, and divided by, it will be 1 plus 10 into something, 1 plus 10 into something. Okay. So we have to multiply by something, and here again we have to multiply by something. Okay. This something 1 is summation of column 4, and here summation of column 4 is coming at 0.2998. Okay. So it is 0.2998. And then we have to multiply by something, and that is summation of column 5. Okay, actually I have written by mistake, I have written it as summation of column 5. It is actually summation of column number 3, and it is written in this column. Okay, so summation of column 3 is 0.05625. Okay, so it is 0.05625. Okay, now you have to be very smart in solving it on calculator. Let us first solve the numerator. 10 multiplied by 0.2998, it comes to 2.998. Let us put it in memory plus. Okay, in case of denominator, don't write 1. We have to first multiply 10 by 0.05625 and then add 1. Okay, so 10 multiplied by 0.05625, it comes to 0.5625. Let's add 1. Okay, so the number on the screen is 1.5625. We have denominator on the screen and we have numerator in our memory. Okay, so 1.5625 divide equal to, so it comes in the denominator. The number is 0.64 on the screen. Let's multiply it by memory recall, and the final answer is 1.91872, or you can simply solve it in your own way. The number should be 1.91872. So let's update this number. It comes to 1.91872. Okay, let's calculate C for another security, and this time it is CF. So please remember, it is not going to be CA, CB, CC. It is going to be in the ranked order. So we have to calculate CF. Okay. In case of CF, again, it will be 10 multiplied by something divided by 1 plus 10 multiplied by something. Okay. And this something is summation of column 4. We have written it over here. And this corresponding number for security F is 0.65005. Okay. So 0.65005. Okay. And now we have to write summation of column number 3 in denominator, which means we have to essentially write this. And this number, corresponding number for security F is 0.13125. Okay. So 0.13125. Let's solve it on calculator. So let's first solve the denominator. No, start with the numerator. 10 into 0.65005. Let's put it in memory. 10 multiplied by 0.13125 plus 1 divide equal, and let's multiply by memory. So it comes to 2.8110. So 2.8110. Let us update this number 2.8110 over here. 2.8110. Okay, let's similarly, in the similar manner, we are going to calculate CF, and then we can calculate CB, CD, CC, and CE. Okay, so CB is equal to 10 multiplied by something divided by 1 plus 10 multiplied by something else. Okay, so we have to multiply it by, let me highlight the columns so that it is easy for us to visualize the things. So this is the column to be used in numerator, and this is the column that we are going to use in denominator. Okay, so we'll multiply by 1.15005. 1.15005, and then we are going to divide it by 0.33125. Okay, 0.33125. Okay, let's put it in calculator. So 1.15005 into 10 in the memory, 0.33125 into 10 plus 1, divide equals, okay, so it comes to 2.6668. 2.66678, so I am writing it as 8. Okay, now after calculating CB, okay, see here you might be noticing that the first CA was 1.91 and the second C is greater than the first C, which means while framing an optimum portfolio, we should not just include A, we should also include F, because C score is increasing. But as soon as we mix security B in our portfolio, the C score has fallen. What it simply means is we should only include securities up to that level where C score is increasing. Now you will notice that as we calculate more C, this score is going to decrease. But this is the formality that we are doing. We have already made up our mind that we are going to include only this two securities, because only until this two securities our C score is increasing. As we include security B, our C score has fallen. And now, because we have already prepared this table in the ranked order of our preference, as we include security D, C, E, which are less preferred as compared to the above securities, the C score will keep on falling. Okay, but let's do the formality. Let's calculate C score for security D. So C score for security D is equal to 10 multiplied by and divided by 1 plus 10 multiplied by something. Okay, so corresponding to security D, it is 1.35005, 1.35005, and it is 0.43125, 0.43125. Okay, let's run it on calculator. 1.35005 multiply by 10, and then 0.43125 multiply by 10 plus 1. Okay, so it comes to 2.541. So here you can notice that the C score has started falling. Okay, let's calculate it for security C. C is equal to 10 multiplied by 1 plus 10 multiplied by. Okay, so the corresponding numbers for security C are 1.60001, 1.60001, and then it is 0.63955, 0.63955. Okay, so 1.60001 into 10, and then 0.63955 into 10 plus 1, divide equal multiply memory. So it comes to 2.16. Here you must be observing that C score has started falling. Now actually we are just doing the formalities, because we have already made up our mind that we are going to include only those securities till the level where the C score is rising. So till this number the C score is rising, so we are going to only include security A and F. But let's complete the formality. The score will keep on falling. Okay, so the last security in the list is security E. Let's calculate C score for security E. It is going to be 10 multiplied by divided by 1 plus 10. Okay, so 1.65977 in the numerator, 1.65977 in the numerator, and then 0.71155 in the denominator. 0.71155 in the denominator, and I can bet with you that this particular C score is going to be less than this one. Are you ready to bet with me? 10 multiplied by 1.65977. Okay, 0.71155 into 10 plus 1, divide equals multiply by memory. Okay, yes, did you bet with me? 2.045. Let's update all these scores in the table above. So we had already updated till 2.811, 2.668, 2.668. Okay, let me remove this. Okay, and then 2.541, 2.541, then 2.16, 2.16, and then 2.045, 2.045. Now, while writing these steps, we talked about calculating CI, and we are going to determine the cutoff. Do you know what is going to be the cutoff? The highest of the CI is our cutoff. So now which CI is the highest? This one is the highest. So it becomes our cutoff and it will be denoted by C star. Okay, let me write this and then I'll further explain you. Two point 2.8110 being the highest CI value, CI value becomes the cutoff point. Hence, C star, we denote the highest cutoff point, or we simply denote the cutoff point by C star. So in our case, the C star is 2.8110. Okay. Now, what is the official rule of selecting the securities? The official rule of selecting the securities is framed a little bit differently, but it will give you the same result. Official rule of selecting security. The official rule is simple. Look at your C star. This is your cutoff point. 2.811 is your cutoff point. Now, all the securities that have, listen me carefully, which securities we have to include in the portfolio. Our cutoff point is 2.811. All the securities that have excess return to beta ratio more than 2.811 will be selected and the rest of the securities will be rejected. Okay. So let us come on to our first table, and this is excess return to beta ratio, and our cutoff point was 2.811. This security has excess return to beta ratio of more than 2.811. Yes, it will be selected. It will be rejected. It will be rejected, rejected, and selected. Which two securities are selected? Security A and F. Or we can simply say that till the time the C score is going up, we will keep on including the securities. But as soon as it starts falling, we are going to discontinue including this securities. We are not going to include this two securities. So even if you go by the official rule, let me write the official rule over here. All securities having excess return to beta ratio, excess return to beta ratio greater than C star, will be selected. Now we can also express this rule in other words, that till the time the C score was rising, all those securities up to the point where C score was rising will be selected, and as soon as C score starts falling, we will reject these securities. Okay. In either case, security A and F are selected. Hence, security A and F are selected. Okay. So till what point we have come? We are now able to select the securities. We rank the securities based on the excess return to beta ratio. We prepared the ranked table and we calculated C score, and then the highest of the C score is denoted by C star, and all the securities up to that highest of the C score level are selected. We have selected security A and F in our portfolio. Now there is one more question in front of us. In what proportion these two securities should be mixed in the portfolio so that it is called as optimum portfolio that generates the maximum return with least risk. Okay. So here comes into picture our step number 3. Step number 3 is to calculate weights. Now to calculate weights, we have another ugly formula that I didn't write here, that I actually wrote over here. Okay, so this is the formula to calculate ZI. Please let me make you clear, ZI is not weight. Zi is the relative proportion of this securities. I'll make it clear. Let us first apply this formula. Okay, so this formula is Zi. Here Zi gives us the relative proportion of the securities in the portfolio. So Zi is equal to Ri minus Rf upon beta. Okay. So Ri minus Rf upon beta, what does it gives you? It gives you excess return per 1 unit of beta. Excess return per 1 unit of beta. Let us deduct C star from here. Okay, because this is the cutoff point. So ultimately, do you understand what we have calculated? We have actually calculated excess return over and above the cutoff point. See, this was our merit list cutoff point, and how further above you are. So this is excess return to beta ratio, and minus C star gives you how much above the cutoff point you are. Okay, now let us multiply it by beta, because higher the beta, higher should be your relative proportion, because you are going to give that much movement, that much percentage contribution in the portfolio's return. But we punish it by unsystematic variance, because do we like unsystematic variance or we hate variance? We hate variance. So we put it in denominator so that we can actually punish the relative weights. Okay, so this is excess return to beta ratio above the cutoff point, and this excess return is multiplied by beta, because higher the beta, higher should be your relative proportion in the portfolio, so that you can contribute more returns. But you should be punished by unsystematic variance, because we hate unsystematic variance in the portfolio. Okay, so let's calculate Zi for security A and calculate Zi for security F. Okay, so let me write it over here so that I can convey you the concept. So we had two securities selected, security A and F. Let's calculate ZA. So for security A, how much is BI? Security A, the BI is 1.5. So let's write 1.5 over here. Divide it by unsystematic variance. So for security A, the unsystematic variance is 40. So let's write 40 over here. Okay. Now, Ri minus Rf upon beta. So Ri is 15, Rf is 7, and beta is 1.5. 15 minus 7 upon 1.5. 15 minus 7 upon 1.5 minus C star. So our C star is 2.8110. Okay, 2.8110. Okay, please solve it with me in the calculator so that I can tell you the concept. 15 minus 7, so excess return is 8 divided by 1.5. So excess return is 5.33 per unit of beta. Now how much this number is over and above the cutoff? So let's deduct the cutoff. 2.811. So this number comes to 2.55 times above the cutoff per 1 unit of beta. Let's multiply it by the beta and divide it by, or punish it by, the unsystematic variance. So multiply by 1.5 divided by 40, it gives you 0.09458.7, 0.09458.7, and I can write it as 5. Okay, now let's calculate this same number for security F is equal to. Now please remember, we have to calculate for security F. We are not going to calculate it for security B, for F. Okay, so the beta is 1.5. Beta is 1.5 divided by unsystematic variance. So unsystematic variance is 30 for security F. Okay, let's open the brackets. N. So it is 14 minus 7 upon 1.5. 14 minus 7 upon 1.5 minus C star. So C star is 2.811. Let us solve it. 14 minus 7 divided by 1.5. 4.667 minus 2.811. And now let's multiply it by 1.5 and divide by 30. Okay, so it comes to 0.092783. Okay, so it comes to 0.092783. Okay. Now please clarify me it to you. This two numbers, these are not weights, because as you already know, see, we are forming a portfolio with two securities. Okay, now if we include this security with this much weight and this security with this much weight, is total of weight going to be 1? No. So this ZI number actually don't give you weights, they give you relative weights. So these two securities are going to have relative weights of 0.094 and 0.092. Let us convert this relative weight into weights. Okay, so what we are going to do is we are going to sum these two numbers up, and then summation of these two numbers would be used as a denominator. So it comes to 0.094. Let me calculate the summation of Zi. Let me calculate the summation of Zi. Okay, so summation of Zi is 0.0945875 plus 0.092783. Okay, so it comes to 0.1873705. Okay, now there is one more formula to calculate weight. Although I know that you can easily calculate weight, take this number in the numerator and divide it by this summation, it will give you the weight. But see, there is a formula. Let's write that formula. Let us see that formula. What is that formula? That formula is, so it gives us relative weights. Zi gives us relative weights. And now to convert in the absolute weights, we have to calculate Xi, where Xi is equal to Zi of an individual security divided by summation of Zi, where I is equal to 1 to n. So that's a very simple formula. Let's not go into the depth, and let's calculate Zi. Let's calculate Xi. And how do we calculate Xi? Zi upon summation of Zi, where I is equal to 1 to n. Okay, so let's calculate weight for security A. Weight for security A is going to be this number divided by this number. So 0.0945875 divided by 0.1873705. Okay, so weights comes to 0.0945875 divided by this number, it gives you 0.5048. So it is 0.5048. And now let's calculate weight for security F. It is going to be 0.092783 divided by the same number, 0.1873705. Let's calculate the weights. So 0.092783 divided by 0.1873705. Okay, obviously the weights will be 1 minus 0.5048, so it is 0.4952. Okay, or we can simply call it as 50.48% of the investment will be put in security A, and 49.52% of the investment will be put in security F to design an optimal portfolio. Let's check the answer. This question is already solved. It has been given to you, and our C score was 2.811. Here it comes to 2.814 due to rounding off. See, the proportions are 50.41%, it matches with the 50.42% and 49.59%. The funds to be invested in security A and F. Okay, so that was the whole process of constructing an optimal portfolio under Sharpe's index model. Let's quickly brush up all those concepts, revise all those concepts in next 2 minutes. Okay, so if in your exams this question comes up, how are you going to solve it? Step number 1, you have to calculate excess return to beta ratio, right? So how do you calculate excess return to beta ratio? Returns minus risk-free rate of return divided by beta, right? So that is our step number 1. Let's calculate excess return to beta ratio and rank them. Okay, now the next step is to prepare a ranked table. Okay, so please remember, you have to prepare a ranked table and copy the data according to the corresponding securities, right? Now you have to calculate CI, and this is the ugly formula. Oh, no, this one is not ugly. Actually, this one is ugly. This is the ugly formula to calculate CI. You have to actually cram this formula. You have to remember this formula. How can you remember this formula? The step number 1 is to actually remember this. CI is equal to deviation m square into something divided by 1 plus deviation m square into something else. Okay, deviation m square, it will be already given to you in the problem, and now we have to figure out what is that something something. Okay, so here the something, the process to solve something is very easy. To solve that something, you have to prepare a table. The first column would be excess return to beta ratio, and second column would be systematic variance upon unsystematic variance. This is actually no beta square upon unsystematic variance. Now when you multiply these two things, you will get this, and you have to calculate summation of this thing, and then you have to calculate summation of this thing. The summation of this things becomes numerator something 1, and the summation of it becomes something 2, which means denominator. And with the help of that, you are going to calculate CI for each of the securities. The highest of the CI becomes your cutoff point, and all the securities that have excess return to beta ratio more than cutoff point are selected. Or the simple rule in exam is, till the time the CI score is increasing, include those securities, right? So please remember, please don't make this mistake that that all the securities that have CI more than the C star will be selected. No, because C star is the highest of the CI. So you are not going to select just that one security. You have to select all the securities that have contributed up to that point in increasing the C score, right? So the rule is, all the securities that have excess return to beta ratio more than C star will be selected. So these two securities have excess return to beta ratio more than C star, and this will be selected. Now the next thing is, okay, I am selecting these two securities. What proportion of my money should be put in these two securities? So now we have to calculate the weights. The simple formula to calculate weight is, first calculate excess return to beta ratio, which means excess return per beta, and then find out how much this return is over and above the cutoff point. So this is actually real excess return per unit of beta. Let's multiply it by beta, but let's punish it by unsystematic variance. Please remember one thing, everywhere in this process we are using unsystematic variance, which means we are using the things in squared terms as far as deviations are concerned. Okay, so this is how you calculate relative weights. Now these are the relative weights. So securities must be mixed in this ratio. Now to calculate the absolute weights or the weights as a percentage of 100, you are going to simply sum up all the ZIs, and then ZI divided by summation of ZI, it is going to give you the weights out of 100%. This much money you are going to put in these two securities to construct an optimum portfolio. So that was the whole process to construct an optimum portfolio using Sharpe's concept. It is called as Sharpe's optimization model or Sharpe's optimal portfolio. I hope you liked this video. If you really liked and learned from this video, do remember to like this video. And for such more exciting videos related to the finance concept, please subscribe to our YouTube channel and turn on the notifications. Thank you.